Hong Kong's proposed 2026 tweaks to its risk-based capital regime are being seen as broadly neutral, but could still influence how insurers invest and manage risk. To offer their perspective on this, we have on the line Christy Lee of AM Best Asia Pacific and Frank Yuen of Moody's Ratings. Welcome, Christy and Frank. So, what's your take on this? Do you agree the impact will be broadly neutral?
I'll look at the implications for the life and non-life sector separately. For the life sector, I broadly agree that the impact is neutral from a credit perspective. The changes are somewhat more positive for non-life insurers. The proposed preferential capital treatment for eligible infrastructure investment applies only to life insurers. This will encourage greater asset allocation to infrastructure debt and equity, particularly for supporting infrastructures within Hong Kong and mainland China. The Hong Kong life sector is enormous, with assets of about 5.3 trillion Hong Kong dollar, roughly 20% of Hong Kong's total banking assets. Infrastructure investments needs to fulfill certain criteria to be eligible for this reduced risk charges. We don't expect this will materially alter the asset quality of life insurance sector. Now, turning to non-life insurance, the proposed recalibrated natural catastrophe risk charge is based on updated industry data and the market inputs. The changes will reduce the capital charge for overseas catastrophe business. And this will effectively enhance non-life insurers and reinsurers to write overseas business in a more capital efficient way. And this would strengthen the competitiveness, particularly in the reinsurance segment.
I can see why people describe the overall impact as neutral, but I also see some long-term benefits. These amendments look like a recalibration rather than a loosening of the prudential standards. Capital relief is being offered to risks which are well-defined and tightly controlled. The amendments also timely updates the capital regimes regarding the emerging trends. Hong Kong insurers show stronger interest on infrastructure investments, and cap risks become a more important drivers for the APAC regions. It could be neutral for the system, but we do see some more positive impact on insurers who have a stronger ALM capabilities, longer dated liabilities, or meaningful general insurance exposures outside Hong Kong.
So, where might the market be underestimating the effects of these changes?
One area that may be underestimated is how these changes support Hong Kong government's ambition to strengthen its role as a reinsurance and risk management hub. Non-life gross premiums for the first 9 months of 2025 is about $83 billion. 56% of that came from onshore risk, indicating that less than half are originated from offshore. By comparison, Singapore's onshore premium base is roughly twice the size of Hong Kong's. This shows the potential for Hong Kong to grow its offshore and reinsurance portfolio. The new rules would also boost the city's attractiveness as a preferred reinsurance domicile.
The market could underestimate the second order impacts. We don't expect any drastic changes on the solvency ratios, but these changes could influence how the insurers make decisions over time. Preferential treatment for qualified infrastructure assets could gradually shift insurers' asset allocations and geographic mix. As insurers have more capacities and interest to invest in this type of infrastructure, bank and asset managers are more eager to source deals. This could help solve supply constraint. On the general insurance side, lower cat risk and reserve charges requirements may also fit into pricings, and also over time would expand the insurance capacity.
Just for better understanding on this, could you explain how could these amendments alter insurers' risk appetite or product strategy?
Hong Kong currently has 86 pure non-life insurers operating in a relatively small domestic market, some already looking overseas as their growth engine. The revised RBC treatment could accelerate the shift by making expansion more capital efficient. That said, insurers need to recognize how their risk profiles will evolve. They need to build stronger underwriting and claims capabilities, buy appropriate reinsurance protections, and have robust risk management frameworks. On the life side, we don't expect major shifts in investment behavior. Infrastructure assets typically have long investment time horizons, so they are widely regarded as good fit for long-dated insurance liabilities from an asset liability matching perspective. Overall, we expect life insurers to maintain prudent investment strategy, balancing the need for the high yield risk, liquidity, as well as duration matching.
Yeah, we don't think these will suddenly encourage insurers to take more risk, but it does give them more flexibility to diversify asset allocations and product mix. For life insurance, the changes just reinforce the appeal of long-dated and predictable cash flow assets. Universal Life is a good example because it's become more capital efficient under the new amendments. For long life insurers, the lower capital fictions could actually support regional growth and encourage them to expand to a more diversified book. Underwriting disciplines still matter more to insurers when they're thinking about sustainable growth. Treatments for crypto assets remain very conservative because of the speculative natures of these asset classes. So we do expect it will remain out of favor for most of the insurers. So overall, the amendments steer insurers to take more risks in areas which are better understood and better matched.
Thank you so much for sharing your thoughts, Christy and Frank.
Thanks for having me.
Thank you. Goodbye.
Once again, those were Christy Lee, Senior Director and Head of Analytics from AM Best Asia Pacific, and Frank Yuan, VP and Senior Credit Officer at Moody's Ratings. For more news, visit hongkongbusiness.hk.